Hello, welcome to Capital Sensei. Today we're going to break down the incredible story of how Warren Buffett went from a kid with a few dollars in his pocket to one of the wealthiest people in human history. We'll explore his earliest business ventures, dive deep into the core principles of his investment philosophy, and most importantly, extract practical financial tips that you, as a beginner, can start applying to your own life today. And as we always do, we try to answer as many questions as we can right there in the comments section. So if anything is unclear, or if you have your own story or insight to share, please leave a comment. It really helps create a community where we can all learn from each other. To really understand how Warren Buffett made his fortune, we have to go all the way back to the beginning. And I mean the very beginning. We're talking about a 6-year-old kid in Omaha, Nebraska. While other kids were playing, young Warren was buying 6-packs of Coca-Cola from his grandfather's grocery store for 25 cents and then selling each bottle individually for a nickel, making a 5-cent profit on each pack. It seems small, but this was his first lesson in business. Buy low, sell high, and understand profit margins. He didn't stop there. He delivered newspapers, sold used golf balls, and even sold stamps to collectors. Each little venture wasn't just about making pocket money. It was a real-world business education. He learned about inventory, customer service, and most importantly, the flow of cash. He was learning firsthand that money could be used as a tool to make more money. This is a fundamental concept that many people don't grasp until much later in life, if at all. Then came the pinball machines. As a teenager, Buffett and a friend bought a used pinball machine for $25. Instead of just playing it, they put it in a local barber shop. Before long, the quarters started rolling in. But here's the magic trick, the part that separates the Buffett mindset from everyone else's. What did they do with the profits? They didn't spend it. They bought another pinball machine and another. Soon, they had a small pinball empire in barbershops all over Omaha. This simple story is perhaps the most powerful lesson in his entire life. The power of reinvesting your profits. He wasn't just earning money, he was putting that money to work to earn even more money. He was building a little army of cash-generating assets. This is the very essence of compounding, a concept we'll talk about a lot more, but it started for him right here, with pinball machines in barbershops. When it was time for college, Buffett initially found it uninspiring. He felt he knew more about business and finance than his professors. But then, he discovered a book that would change his life forever, The Intelligent Investor by Benjamin Graham. For Buffett, reading this book was like a religious experience. Graham was a professor at Columbia Business School, and Buffett knew immediately he had to go there and learn from the man himself. Benjamin Graham is widely considered the father of value investing, and his core idea, the one that lit a fire in Buffett's mind, is deceptively simple. Graham argued that a stock is not just a ticker symbol or a blip on a screen. It is a fractional ownership of a real business. Therefore, you should analyze a stock with the same care you would use if you were buying the entire company. You need to understand its value, independent of its price. Now, this is a key distinction, the difference between price and value. The price is what you pay, the value is what you get. The market can be moody. Prices can swing wildly based on fear and greed. But the underlying value of a good business is much more stable. Graham's genius was in creating a systematic way to determine a business's intrinsic value, its true underlying worth. The goal is to then buy it for a price significantly below that value. To make this crystal clear, imagine you're a car expert. You know that a specific model of a 2015 sedan in good condition is reliably worth about $10,000. That's its intrinsic value. Now, You go to a dealership and see the sticker price is $15,000. That's the market price. Obviously, you wouldn't buy it. But what if you find someone in a hurry to sell who is offering the exact same car for $6,000? You'd snap it up in a heartbeat because you know you're getting $10,000 of value for a $6,000 price. That is value investing in a nutshell. To help his students understand the chaotic nature of the stock market, Graham came up with a brilliant analogy: Mr. Market. Imagine you are business partners with a very moody fellow named Mr. Market every single day. He comes to you and offers to either sell you his share of the business or buy your share. The catch is, Mr. Market is emotionally unstable. Some days he's euphoric, convinced your business is the greatest thing ever, and he'll offer you a ridiculously high price for your shares. Other days, he's deeply depressed and pessimistic. He sees nothing but doom and gloom and will offer to sell you his shares for pennies on the dollar. The beautiful thing is, you are under no obligation to trade with him. You can completely ignore him. A smart investor doesn't get swept up in his moods. Instead, you use them. When he's pessimistic and offering a silly low price, you buy. When he's euphoric and offering a crazy high price, you might consider selling. This mindset prevents you from making emotional decisions. This leads directly to Graham's other pillar of wisdom: the margin of safety. This might be the single most important investment concept ever. The margin of safety is the difference between the intrinsic value of a business and the price you pay for it. In our car example, the $10,000 value versus the $6,000 price gives you a $4,000 margin of safety. Why is this so crucial? Because the future is uncertain. Your calculations of intrinsic value might be wrong. The company might face unexpected problems. The economy could take a downturn. The margin of safety is your buffer against all of that. It's like building a bridge that can hold 30,000 pounds, even though you only ever expect 10,000-pound trucks to cross it. It's the extra room for error that protects you from bad luck and your own mistakes. For Buffett, investing without a margin of safety is simply gambling. After graduating from Columbia, Buffett went to work for Graham's firm, Graham Newman Corp. Here he honed his skills, digging through financial reports, searching for these bargains, companies trading for less than they were worth. He was a master at this, but he was mostly practicing what's known as cigar butt investing. This is Graham's classic style. You look for a cigar butt on the street that has one good puff left in it. It's not a great cigar, but you pick it up for free. Get that one last puff and toss it. In investing terms, this meant finding mediocre companies that were trading for a ridiculously cheap price, often for less than the cash they had on hand. You'd buy them, wait for the market to correct the price slightly, make a small, quick profit, and then sell. It worked, but it wasn't a great way to build massive, long-term wealth. You were constantly searching for new cigar butts. In 1956, at the age of just 26, Buffett returned to Omaha and started his own investment partnership with about $100,000, mostly from family and friends. He ran these partnerships for over a decade, and his results were simply staggering. While the major market indexes were doing okay, Buffett was delivering returns of over 25% per year, consistently. He was becoming a local legend. During this time, he was still largely a cigar butt investor. A perfect example is his purchase of a struggling textile mill called Berkshire Hathaway. It was a terrible business in a dying industry, but it was cheap. The company was closing mills and its stock price was falling. But the value of its remaining assets was actually more than the total price of all its stock. So, Buffett started buying up shares, planning to make a small profit as the company liquidated. But then something happened that changed his entire trajectory. This is where Charlie Munger enters the story. Munger, another brilliant Omaha native, became Buffett's partner and lifelong friend. Munger had a different perspective. He wasn't just interested in finding cheap, mediocre businesses. He pushed Buffett to evolve his thinking. Munger's philosophy was simple. Forget what you know about buying fair businesses at wonderful prices. Instead, buy wonderful businesses at fair prices. This was a profound shift. Instead of looking for a cigar butt with one puff left, Munger convinced Buffett it was far better to buy a truly great business, even if you had to pay a reasonable, fair price for it, and then just hold on for decades. A great business would continue to grow and generate value year after year, compounding your wealth along with it. A mediocre business, even if bought cheaply, would always just be mediocre. The first major test of this new philosophy came in 1972 with See's Candies. See's was a beloved, high-quality chocolate company on the West Coast. It wasn't a struggling textile mill. It was a fantastic business with a loyal customer base and a strong brand. The asking price was $25 million. Buffett's old cigar butt? Instincts screamed that this was too expensive. The company's physical assets were only worth about $8 million. But Munger pushed him. He saw the intangible asset, the brand. People loved See's Candies and were willing to pay a premium for it. This gave the company pricing power. They could raise their prices a little bit each year to keep up with inflation, and customers wouldn't blink an eye. They would just pay it. This was a wonderful business. And they could buy it at a fair price. They made the deal. See's Candies has since generated over $2 billion in profit for Berkshire Hathaway, and it required very little additional capital investment. It was a money-printing machine. This purchase taught Buffett a crucial lesson. It's far better to own a piece of the Hope Diamond than to own all of a rhinestone. The quality of the business is paramount for long-term compounding. So what makes a wonderful business in Buffett's eyes? He looks for a few key things. First, he wants a business he can understand. This is his famous circle of competence. Buffett is famous for saying he doesn't invest in things he doesn't understand. That's why he avoided technology stocks for decades during the dot-com bubble of the late 90s. It wasn't that he thought they were all bad companies. He just didn't feel he had any special expertise to tell the winners from the losers. Think of it like a mechanic. A great mechanic who specializes in German cars knows everything about them. He can diagnose a problem just by listening to the engine. He has an edge. But if you ask him to fix a helicopter, he's going to wisely say no. It's outside his circle of competence. Sticking to what you know dramatically reduces your risk and gives you an advantage over other investors. Second, he looks for a business with a durable competitive advantage, what he calls an economic moat. Just like a moat protects a castle from invaders, an economic moat protects a company's profits from competitors. This moat can come in a few forms. It could be a powerful brand, like Coca-Cola. People all over the world ask for a Coke, not just a cola. That brand loyalty is a massive moat. It could be a low-cost advantage, like Geico Insurance. By selling directly to consumers instead of through agents, Geico can offer lower prices than its rivals. It could be a network effect, like American Express. The more people who have the card, the more merchants want to accept it, and the more merchants who accept it, the more people want the card. The moat gets wider and deeper over time. Buffett wants to buy a castle protected by a very wide moat that is getting wider. Third, he looks for management that is able and trustworthy. He's not just investing in assets, he's partnering with people. He wants to see a management team that is rational, honest, and acts in the best interest of the shareholders. He often says he looks for managers who love the business, not just the money they can make from it. When he buys a company, he often keeps the existing management in place for years, even decades. So, let's bring this all together in the mothership. Berkshire Hathaway. The struggling textile mill he bought as a cigar butt eventually became the holding company for all of his investments. Today, Berkshire Hathaway is one of the largest companies in the world, but it doesn't really make anything itself. It's a holding company, which is like a giant container that owns lots of other businesses. Berkshire owns some companies outright, 100% of them. Think of Geico, Dairy Queen, Duracell batteries, and the BNSF Railway. These are wholly owned subsidiaries. Then, it also owns a massive stock portfolio with large stakes in public companies like Apple, Bank of America, and Coca-Cola. It's a unique structure that gives Buffett incredible flexibility. But here is the real secret sauce, the financial engine that supercharged Berkshire's growth: insurance float. Now this sounds technical, but let me break it down. When you buy car insurance from a company like Geico, you pay your premium up front. Let's say you pay $1,200 for a year of coverage. Geico gets that $1,200 on day one, but they don't have to pay out claims right away. Accidents happen randomly over the course of the year. So, for a period of time, Geico gets to hold onto your money and the money of millions of other customers. This giant pool of money that has been collected but not yet paid out in claims is called float. Buffett realized that he could invest this float for Berkshire's own benefit. Essentially, he was getting a massive, continuous, interest-free loan from his insurance customers. And in some years, when the insurance operations are profitable, it's actually better than an interest-free loan. It's like getting paid to hold on to someone else's money. This float provided billions upon billions of dollars in permanent capital that Buffett could then use to buy more wonderful businesses and more stocks. This was the rocket fuel. And that brings us to the almost magical force behind his wealth: compounding. Albert Einstein supposedly called compound interest the eighth wonder of the world. The concept is that snowball rolling downhill. It starts small, but as it rolls, it picks up more snow, getting bigger and bigger. And the bigger it gets, the faster it grows. Money works the same way. Let's use some simple numbers. Imagine you invest $10,000 and earn a 10% return in the first year. You now have $11,000. The next year, you earn 10% again. But now, you're not earning it on your original $10,000. You're earning it on $11,000. So you make $1,100, bringing your total to $12,100. The year after that, you earn 10% on $12,100. Your money is making money, and then the money your money made starts making money too. It doesn't seem like much at first, but over long periods, the results are mind-boggling. Buffett's wealth is a testament to this. A famous chart shows that over 99% of his net worth was earned after his 50th birthday. It wasn't just about high returns. It was about achieving good returns consistently over an incredibly long period of time. Time is the most critical ingredient for compounding. So how can we, as beginners, apply these monumental lessons to our own financial lives? We may not be buying whole companies, but the principles are universal. The first and most important step is to live below your means. You cannot invest money that you don't have. Buffett is famously frugal. He still lives in the same house he bought in Omaha in 1958 for $31,500. He eats breakfast at McDonald's. This isn't because he's cheap. It's because he understands opportunity cost. Every dollar he spends on a lavish lifestyle is a dollar that can't be invested and compounded into many more dollars in the future. You don't have to live like a monk, but you must make a conscious decision to spend less than you earn. Track your spending, make a budget. Find the leaks in your financial boat and plug them. This creates the surplus you need to start investing. Second, invest in yourself. Buffett has said that by far the best investment you can make is in yourself. What does he mean? Your own earning power is your biggest financial asset. Anything you do to increase that power, getting more education, learning a new skill, improving your communication abilities, taking care of your health, will pay you back tenfold over your lifetime. No one can tax it away or steal it from you. An investment in your own skills is an investment with guaranteed returns. Third, make saving and investing automatic. Don't rely on willpower. The single best way to do this is to pay yourself first. Set up an automatic transfer from your checking account to your savings or investment account for the day after you get paid. Before you have a chance to spend it on bills, rent, or fun, a portion of it is already put away and working for you. This removes emotion and turns wealth building into a habit, like brushing your teeth. Fourth, for the vast majority of people who don't have the time or interest to analyze individual businesses, Buffett has a very simple recommendation. Consistently buy a low-cost S&P 500 index fund. An index fund is a type of mutual fund that holds a basket of stocks designed to mimic a market index, like the Standard & Poor's 500. Instead of trying to pick the one winning stock, you're buying a tiny slice of 500 of the largest and most successful companies in America. It's the ultimate diversification. You're betting on the long-term success of the American economy as a whole. It's a simple, effective, and low-cost way to participate in the market's growth and harness the power of compounding without becoming a financial expert. Fifth, you must learn to think long-term. Investing is not a get-rich-quick scheme. It is a get-rich-slowly plan. Once you buy your index fund or your stocks in wonderful companies, the best thing to do is often nothing. Don't panic when the market drops. Remember, Mr. Market, he's just in one of his moods. Don't get euphoric and greedy when it's soaring. Your job is not to time the market swings. It's to own productive assets for a very long time. Investing should be more like watching paint dry or watching grass grow. If you want excitement, take $800 and go to Las Vegas. Finally, avoid debt, especially high-interest consumer debt. Credit card debt is the evil twin of compounding. When you invest, compounding works for you. When you're in debt, it works ferociously against you. A 20% interest rate on a credit card will destroy wealth far faster than you can build it with a 10% investment return. Buffett has said, if you're smart, you're going to make a lot of money without borrowing. Pay off your high-interest debts as quickly as possible. It's the best guaranteed financial return you can get. Warren Buffett's story is not about complex algorithms or risky bets. It's about discipline, patience, and a set of rational, timeless principles. It started with selling gum and reinvesting profits from pinball machines. It evolved through the wisdom of teachers like Benjamin Graham and partners like Charlie Munger. It was powered by the financial engine of insurance float and the unstoppable force of compounding. By understanding these core ideas, businesses, not tickers, demand a margin of safety, stay in your circle of competence, and think for the long term. You can build a powerful foundation for your own financial success.